Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to purchases and sales involving foreign currency. So we have purchases and sales taking place, and we're going to have to deal with the foreign currency that will be involved within them. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. We're going to go over the information for our problem all at once. Then we're going to pull pieces of that information so that we can see them as we work through components of the practice problem. We will, in essence, have a few different scenarios for purchases and sales that will take place that will have a foreign currency component to them. First item, 3-1 U.S. company. That's going to be us, where the U.S. company sells to a Canadian company, and the sales price was 42,000 Canadian dollars. Then the receivable is going to expire. We're going to collect on 5/30. To do this, we're going to need the spot rates for the relevant dates on 3/1 and 5/30. Spot rates being 1 Canadian dollar, the equivalent US dollars being 0.65, and then on 5/30, 1 Canadian dollar, the equivalent being 0.68 US dollars. Next scenario, on 7/1, US company, us once again, enters into a contract to purchase machinery from a Japanese company. So now we're purchasing from a Japanese company machinery. We're purchasing this time. We have a cost of the 400,000 yen, and the machinery is going to be delivered on 8/30. So that's when the actual delivery happens. And then on 10/29, the payment due 60 days later. So then we're going to have the relevant items, the relevant spot rates for that on 7/1, 8/30, and 10/29, this time comparing the 1 yen compared to the relevant dollar amount. So 1 yen as of 7/1 is $0.106. 1 yen on 8/30 is $0.104. And 1 yen on 10/29 is $0.106. On 8/30 X1, 60-day forward exchange rate is 1 yen compared to $0.106. Now, we're going to put in these forward exchange rates because we will be using them later, and you want to basically know when to use the forward exchange rates and when to use the spot rates. But for this problem, we're basically going to be using the spot rates, and we got this added information in there, as you might see in practice problems, that we're not going to use here, but we will be using those in future problems, and you want to get used to seeing those two kind of rates that could kind of throw you off in like a multiple choice question or practice problem situation. So then we have on 11/16, U.S. company, us, purchases inventory from a London company. The price is going to be 20,000 pounds, Great British pounds. And so then on 1/15 X2 is the payable. And then we have the spot rates for them, which is going to be on the relevant dates, November 16th, December 31st, January 15th. 1 pound is $1.65. Then on December 31st, 1 pound is $1.630. And then on January 15th, 1 pound is $1.64. We also have the forward rate on December 31st, 2000 X1. Again, we won't be using that in this problem, but you want to get used to seeing those forward rates as kind of mixing things up or seeing the two rates and choosing which one you need to use. All right. So let's go back into the first scenario here. So we have 3-1, U.S. company sells to Canadian company. We're selling to a Canadian company, and the sales price was 42,000 Canadian dollars. 42,000 Canadian dollars. So the first transaction that's going to be happening here is going to be recording that receivable. Now we're going to get basically Canadian dollars, but we want to record that as U.S. equivalents. Now you want to think about this, or I would think about this as basically measuring anything else. Like if I was to measure machinery or something like that, we're not going to say that we have one forklift on the books. We're going to say that we have so many dollars worth of forklifts-ness. We have to measure it in dollars. The dollars is our ruler. The dollar is our measuring tool. So that's what we're gonna do. And we're gonna do the same thing for foreign currency. It just seems a little weird with foreign currency because foreign currency is itself a measuring tool. It's like we're using a ruler to measure a yardstick. I mean, they're two different measuring tools, but our measuring tool is in rulers, if that were the case in this scenario, or in dollars, not in, of course, the Canadian dollar, and therefore we're just going to revalue it just like we would with anything else in terms of dollars. It just so happens that, of course, the foreign dollar will change in relation to our ruler, our US dollar, a lot, just like a security would, just like if we were putting money into stocks. And we can know what that change is because there's a market, and we can therefore use the market to adjust our rates periodically when we need to. When are we going to need to be adjusting our rates? whenever there's going to be an activity that's going to happen, or at our end balance sheet dates. At the end of the year, when we do our financial statements, we'll have to revalue just like we would periodically with securities or something like that has a set market, so we can easily see what the current rate is, what the exchange rate is, what the current value is in terms of our measuring tool, our ruler, which is $1. Okay, so what we're going to do then is we're going to say that we have this 42,000 Canadian dollars that we're going to get in the future, 42,000 Canadian dollars, and we're going to multiply that times the spot rate. Now, the spot rate represents basically the exchange rate today at this point in time. So we're not going to get the money until later. So the spot rate could change. This exchange rate will change over time, but as of now, we can only measure it for what it is at this point in time. So we're going to, and now later we can kind of predict that, and that's when we'll get to the, predicted rates. But right now, we're just going to say, hey, look, this is what we know as of this point in time. This is the exchange rate on it. So we've got the 42,000. We're going to be multiplying that times the 0.65 times 0.65. That means we have a receivable of $27,300 worth of Canadian dollars, right? So we're putting it on the books at 23,000. A receivable is increasing. We're noting that the receivable is in Canadian dollars, representing the fact that the money that we will actually receive will be in Canadian dollars, but it's representing in our financial statements, just like everything else, we're measuring it in US dollars, which as of this point in time is US dollar equivalent of 27,300. The other side then going to sales. So we made the sale down here. We're increasing the sales by the 27,300, which basically represents the value of the stuff we're getting, just like we would if we sold something for equipment or something like that. We'd have to value the equipment and then say we made an exchange for it or something like that, right? We revalued the other currency to our currency and said we got $27,300 worth of sales. So that's going to be our first transaction. Moving on to the second transaction, notice as we go through, what we're going to say is this is going to be the first transaction we've done thus far. This is going to be the one that we're working on, the big transaction down below it. And then we're going to have our worksheet, which is going to have our beginning balances, which of course just has the basic beginning balance account so we can focus in on what we're doing. The entries then will be including everything that we have done up until this point in time. So it includes the prior journal entries up until this point and the current journal entry that we will be working on. So now we're going to say that we have the receivable took place. So if we go back up, we got the receivable is now taking place on 5/30. So on 5/30, we will be collecting on this. So we're going to be collecting on the receivable that we had up top. So we have the receivable that we're now going to be collecting on. However, it's no longer at the 27,300 exchange rate because now time has passed and the exchange rate is going to be different. So before we calculate or before we record the fact that we have received the receivable, we need to revalue the receivable to the current value of the receivable at the point in time that we're going to get the money. So to do that, we're going to say, all right, now we're going to get the receivable. We got the 42,000. We could do it a couple different ways. We could say we've got the 42,000 times the current spot rate at 5/30, the point in time that we're going to actually get the money, get the Canadian dollars times 0.68. That's going to be the 28,560. And so that's what we want the ending number to be, as we can see after we record the transaction here. Here's what the beginning number was. So if I take this number minus what's currently in there before we record the transaction, 27,300, then we have a difference that we're going to have to record of the 1,260. 1,260 is going to mean that we're going to have to increase the receivable and we're going to have to record the other side, a credit, which is going to be a gain. So as we think about these gains and losses and these changes, you want to start getting in your mind, well, what happens with this money? If this currency gets stronger, what happens, gain or loss? If this currency gets weaker, what happens, gain or loss? And the factors that will be taken into consideration when you do that is, the currency that's getting stronger or weaker can be phrased in a couple different ways. You can say the Canadian dollar got stronger versus the US dollar, or the US dollar got weaker versus the Canadian dollar, right? Or you could do vice versa. So you can frame it in terms of the Canadian or US dollar strengthening or weakening compared to the other. So that's one thing you got to kind of wrap your mind around. The other thing we need to consider is whether or not we're going to get paid in Canadian dollars or in the foreign currency in the future as a receivable, or are we paying in the foreign currency some amount in the foreign currency in the future, which of course will have an effect as to whether this is going to be a good thing or bad thing for us. Now, the only way to really get this is just to keep working problems. If you actually work the journal entries, then you'll start to kind of get a feel for this. So in this scenario, we're going to get paid Canadian dollars in the future. We have a receivable in the future on the books. They're going to pay us not in US dollars, in Canadian dollars. That means since we already have a commitment to get money in the future in Canadian dollars, we want the Canadian dollars at this point to get stronger, because if they got stronger, then we're going to get paid in something that has more purchasing power in relation to the US dollar. So here, if we think about this, we're going to say, all right, on 3/1, we had 1 Canadian dollar was equivalent to 0.65 US dollars. And then on 5/30, we had 1 Canadian dollars now worth 0.68 US dollars. So 1 Canadian dollar now is equivalent to more US dollars, or more fractions of a US dollar. That means the Canadian dollar got stronger with relation to the US dollar, or you can phrase it as the US dollar got weaker. But since we're going to get in relation to the Canadian dollar, but we're going to be phrasing it in terms of Canadian dollars because that's what we're going to get paid in. So we're going to get paid in Canadian dollars, which just got stronger with relation to the US dollars, which is good for us because we've already been committed to get that money, and that's now going to be given to us in a stronger, which is a stronger currency. So that's going to be a gain. Now, the other way you can calculate the gain, and which is useful, you'll often see, is that you could take the difference in the rates, which is going to be 0.68 minus 0.65, and then multiply that difference times the 42,000. And that will also give you that 1,260. So what are we going to do from a journal entry standpoint? We're going to increase the receivable that's going to be given in Canadian dollars by the 1,260. Now it's up to that 28,560. And you'll recall that 28,560 was, if we calculate this out, it's the 42,000 times the current spot rate, the 0.68. So that's the 28,560 that we have now. And then we've got the foreign currency gain down below. We're going to record the gain on the foreign currency. So once again, this amount here represents the receivable that we expect to get, but we're going to get paid in Canadian dollars. We're going to get paid in 42,000 Canadian dollars, which is now worth, according to the current exchange rate, the 28,560. Next, we can record us actually getting paid. So we're going to get paid in the next transaction. What are we going to get paid in? 42,000 Canadian dollars. We're getting Canadian dollars. Now, you can think about this. I would think about it just like we got paid with like machinery, or we got paid with something other than cash, like some kind of physical thing we got paid with that has value, like a machinery or something like that. What we're going to do is we're going to put it on the books, and we're going to value it in terms of US currency. So the fact that it's another currency and it's used as a ruler for other people on their financial statements doesn't change the fact that to us it's basically another type of asset, just like if we got like equipment or something, which we're going to have to put on the books at the valuation of our US currency. So as we do this, note that we have our information thus far. This is the transactions we've recorded thus far. Those transactions and the new transactions are now in the entries item here. They're already included in the entries item here. So this is if you want to see the prior items, this is what we had before. This is after we've entered the new transaction, which is going to be this transaction. So what we're going to do is we're going to say that the foreign currency units is what we received, 28,560. This is just like another asset. You might say, well, why isn't it in cash? Well, we didn't get cash. We've got foreign currency. We got 48,000 Canadian dollars. We're holding on to 48,000 Canadian dollars now, which we got to record as basically currency, but not our currency. We're just recording it as another asset, but we're measuring it in terms of our currency. We're putting it on the books not at 42,000 Canadian dollars, but just like we wouldn't put it on the books as one forklift, we're putting it on the books at 28,560 US dollar equivalent at that point in time. And then the other side is going to be bringing down the accounts receivable. So the accounts receivable is now back to zero. It was on the books at the 28,560. It's now going off the books and now is down to zero. And we have been paid. Again, we didn't get paid. It's not a normal, it's a payable of a receivable in Canadian dollars that we're going to receive, but the receivable was on the books in terms of the US dollar equivalent as well. Now, obviously, the number is going to be that same 28,560, which is the current value at the current point using the current spot rate, meaning the 42,000 Canadian dollars times the current spot rate, which is 0.68 current valuation being the 28,560. So then at the end of this process, we now have the foreign currency on the books at the 28,560. That represents the foreign currency that we're holding, which is 42,000 Canadian dollars at the current rate for in terms of the US dollars. We have the receivable has now been paid off, and then we have the sale that took place, the sale on the books at the sale at when the sale took place, or meaning the 42,000 that we expect to get in the future times the spot rate at the point in time that the sale took place, which was on 3/1. Then any change that happened, notice we didn't adjust the sales price, we adjusted the gain. We basically recorded the gain involved with it. Now we'll go to the next scenario. Now the next scenario is just going to move forward on our same company. So we're the same company, we're the same US company, and we've already entered these transactions which are included in the entries section. But now we're going to do another kind of foreign currency related transaction, another basically scenario with a different company and a different foreign currency. And that's going to be down here. We're on 7/1. The US company, that's us, now enters into a contract to purchase machinery from a Japanese company. So the cost of the machinery is 400,000 yen, and the delivery is going to happen on 8/30. That's when the delivery happens. On 10/29, the payment is due. That's going to be 60 days later. Here are the relevant spot rates comparing the yen to the dollar at the relevant points in time. Now, first of all, we had an agreement here, but it wasn't, we're not going to record anything at the point in time that the contract was put into place because, one, we don't have the machinery at that point in time, and we have not yet paid for it. So although we have this kind of agreement that's happening from a transaction standpoint, we don't have the machinery, we haven't paid for the machinery, so there's no financial transaction that we're going to record there. Therefore, we're going to start off with our journal entries down here on 8/30 when the delivery happened. We're going to say now the delivery happened on 8/30, but it's not going to be paid for until 10/29 or 60 days later. So then we're going to put the machinery on the books, and we're going to record the payable at this point in time on 8/30. Now to do so, let's take a look at our calculations once again, because we're going to make the payment in this. The price is 400,000 yen. So we're going to pay this 400,000 yen. So now we have a payable rather than a receivable that we're going to be putting on the books, and we're going to record the fact that we're going to be paying this in yen, but we're going to put it on the books at the current period equivalent. So we're going to put the machinery on the books at the cost of the machinery at this point in time, given the current exchange rate measured in US dollars, which is going to be the 400,000. 400,000 yen is compared to $0.104 as of this point. So we're going to say times 0.104, and that's going to give us the 41,600. Notice, again, we used the 8/30 date because that's the point in time that we actually received the machinery. Then the other side, we're going to record a payable. We're going to record the payable on the books, even though we're going to make the payment in yen. We're going to pay yen, 400,000 yen. We're going to measure this in our books in terms of US dollars, what's going to be obligated in US dollars, which is the 41,600 US dollars. So we have then the machinery going on the books and the payable going on the books, and the indication that the payable will actually be made in a foreign currency, the yen. Now, in the future, of course, what's going to happen is this payable rate is going to change because we have not yet paid it. When we pay it, the spot rate may be different at that point in time. What we're not going to change is the value of the machinery when the spot rate changes. What are we going to change instead? We're just going to account for any difference in the spot rate, the foreign exchange rate, as a gain or loss when we do that. When are we going to do it? Well, either when we pay it and or when a balance sheet takes place, when we have to do an adjusting entry for it, as we would with basically a security or some other type of investment. So let's go to the next transaction. So once again, all of these items, including the first scenario and up through the current item we are working in, are going to be included in the entries section. We're working on the larger transaction at this time. So this time we're going to say then at 10/29. So at 10/29, that's when the payment is due. So the payment is due at 10/29. Therefore, we have this payable on the books that is going to become due. Now, this payable, we're actually going to make the payment in yen, 400,000 yen. And this payable is on the books as of the 41,600 measured in dollars, right? Because we're going to pay it in yen. That's the dollar equivalent. But now we need to revalue that to the current point in time the time that we make the payment, which is now 60 days later. So we're going to be using the new spot rate, which is this 0.106. So let's pull out the trusty calculator here. I'm going to say, all right, trusty calculator. And we're going to say we have the 400. Oh, something happened there. Hold on just a sec. All right, so we have the 400,000 times, we're going to use the new rate, which is going to be the 0.106 times the 0.106. And that's going to give us the 42.4. If we compare that to what's currently on the books, the 42.1 minus the 41.6, sorry, the 41.6, that's going to give us an $800 difference. It's going to be an $800 difference that we're going to have to basically increase the payable for, which means to us, it's going to result in a loss. So again, you want to get used to when is this thing going to be a good for us or bad for us. This time, note this is different because we have an accounts payable. So you want to think strengthening or weakening of the currency. Is that going to result in a gain or loss when that happens? Is that good or bad? Well, here we have then on one yen was at the point in time that we put the payable on the books, which means we're going to pay in yen in the future, was worth $0.104. Now, at the point in time that we're going to pay in yen, the 1 yen is worth 0.106 in dollars. So now the yen has strengthened, right? The yen, 1 yen is worth more dollars over the point in time. And we already have promised to pay 400,000 yen at the beginning of this contract. And now the yen that we're paying at the end of the contract, when we're actually paying it, is worth more. It has more purchasing power in compared to the US dollar. That's bad, right? Because now we're paying something that has a higher value than it had when we basically committed that we're going to pay for it in the past. And that's going to result in our loss here. So we're going to say, all right, so the foreign currency loss is going to be that 800. Also note the other way you want to calculate, and just know to calculate the 800 is to take the difference in the rates, which is 0.106 minus the 0.104. And then that's 0.02 times the 400,000. That's going to be the $800, right? There's the 800. So now we've got the foreign currency loss is going to be $800. Then the accounts payable is going to go up by $800. So we have the foreign currency loss calculated down here. That's going to affect the net income. And then the accounts payable, now we're increasing it. So now we've included that $800 here. The total payable now in US equivalent dollars, we're going to be paying, remember, 400,000 yen. But the current equivalent dollars of that is 42,400 as of the current spot rate, which one more time is calculated as the 400,000 times the 0.106, the 42.4. So now we can go ahead and make our payment of the 400,000 yen, and it'll equal the correct dollar amount here. But before we make a payment in yen, we're going to have to purchase some yen. We're going to have the actual currency on the book. So that's what we're going to do next. Now remember, up until this point, everything up until this point, and including the current journal entry, is included here. And then we'll bounce back from the prior transaction. This was prior to our latest journal entry, which is going to be this one. So we've got this item. This is where we left off last time. Now we're going to be entering this. Those are included here. It's not included in the one right above it. Okay, so now we're going to say that we need some yen. All right, we got to get some yen because we got to pay off this debt that we have. And we already know what the current spot rate is to do it. So what we're going to do is we're just going to say cash is going to go down. We're going to spend some of our US dollars and we're going to purchase us some yen. And we already know what the spot rate is because this is happening on 10/29. So we're simply going to buy enough yen for us to pay this thing off, which is going to be the 400,000 times the 0.106 is the equivalent. So we're going to record on our books then the foreign currency in the units of yen. So we purchased us some yen, $400,000 worth of yen. We went and said, hey, give us $400,000 worth of yen. We're going to put that on our books though. We're going to value it on our books. So now we're holding on to foreign currency, which we're going to value based on the US currency, because that's the ruler that we use, just like if we had stocks or anything else. And we're going to put that on the books at the 42,400. So here we have the foreign currency. It's cash, yeah, but it's not our cash. It's basically an investment to us. So we got the 42,400 in foreign currency, which represents the 400,000 yen that we have. And then the cash is going to go down. We're paying cash for it, so cash is going to be decreasing. So there we have that. Now we have the yen on the books that we're really holding on to the 400,000 yen, which we're reflecting on our books at the cash equivalent or the dollar equivalent of $42,400. Now we can go ahead and use that to pay off our accounts payable. So we'll move on to the next transaction here. Again, everything up until this point and including the current journal entry is included in this transaction, and now and the prior transaction, of course, is not including the latest one, which is this one. So now we're just going to pay off the payable. So now we're going to pay off the payable. So the payable is going to go down. We're going to debit the payable for that 42,400 that we just got in yen, which really reflects once again the 400,000 yen that we have. We're paying 400,000 in yen, but we're paying off the payable, reflecting that in US dollars as they are on our books, which means that the payable now went down to zero. And then we paid it with the foreign currency, the yen, right? So then the yen went down to zero as well. We closed out the yen then goes back down to zero, and we have paid that off. So at the end of the day then, now we have cash on the books here. We've got the foreign currency in Canadian units because we're still holding on to those Canadian dollars that we're valuing in US dollars. The foreign currency units for the yen is now gone because we paid the yen. The machinery is now on the books. It's basically on the books for the amount of the original exchange rate when we originally had the agreement, or we got delivered the machinery and we recorded it on the books there. Any difference between the rates then was reflected in terms of gains and losses for those differences as they have happened since the point in time that the transaction took place to the point in time the money was exchanged. Okay, going to the next item. Remember that we're going to the next scenario now, but all of these transactions are all still there. This is the same company, so this is included in the entries in the middle column, and now we're going to be including the new transaction we'll be taking a look at, which is 1116 U.S. company purchased inventory from a London company, which is the price at 20,000 pounds. So now we're talking pounds, Great British pounds. So on 115 X2, we have the payable here. So the spot rates are going to be November 15th, December 31st, and January 15th. So now we purchase inventory. So now we're purchasing once again, and we're purchasing it on account, and then we're going to pay it off next year in January of next year, which means we have this December point, which is usually when we need to make financial statements, where we're going to have to make this adjusting entries on December 31st as well. So first we're going to put this thing on the books. It's basically the same starting point, but now we're using pounds. So we're going to say, all right, so we got this inventory that we put on the books that we're going to pay in the future. It's a payable just like normal, but when we pay it off, we're going to have to pay it in pounds rather than in dollars. So we're going to have to do the exchange thing. So we're going to use the current spot rate when we put it on the books to record it on the books because that's all we have at this point in time. So we're going to say we got inventory, so that's going to be 20,000 pounds that we're going to pay in the future times the current spot rate, which is 1.65. So 1 pound is equivalent to $1.65. So that's going to be 33,000 on the inventory. So the inventory is on the books, measured in US dollars, 33,000, when we're actually going to be paying 20,000 pounds, and we're going to be paying that 20,000 pounds next year, January 15th. And then we have the payable on the books, which we're going to value in US dollars at 33,000 payable, even though we're actually going to be paying 20,000 pounds next year because we're going to just value it in what we have at this point. So the inventory then goes on the books at the 33,000, and then the pounds are going to go on the books, or the liability goes on the books in basically the pounds of the 33,000. So next thing that's going to happen, we're going to scroll down. Again, all the transactions that have happened thus far, including this one, are now included in our entries over here. We have now this balance sheet date at the end of the year. We got December 31st, and we need to revalue then our information, which is going to be basically the payable that we have as of the point in time that our balance sheet. This is just an adjusting entry basically at this point. We're revaluing just like we would with securities, our current basically holdings and our what we owe to the current value, considering the fact that there is a market for it, right? There's a market, so we can revalue it. So then we're going to say, all right, let's revalue this thing as of the end of the year here. So we're going to say we have the 20,000 that we're going to owe, and the current rate, the current spot rate is 1.63. So 20,000 times 1.63 is going to be the 32,600. We currently have on the books 33,000. So we're going to actually remove that's going to decrease the payable. So I'm going to take this minus the 33,000. We're going to decrease it by $400, which is good. That's going to be basically a gain that we're going to record at this time. Now, why would it be a gain? Because before we had 1 pound was worth $1.65. Now 1 pound is worth $1.63. So what happened then? The pound got weaker because 1 pound is worth less dollars. 1 pound is worth less dollars. And we're going to be paying in pounds in the future. We've committed to pay 20,000 pounds. The 20,000 pounds was equivalent to $33,000. Now the 20,000 pounds is equivalent to less dollars. So that means that's good for us because now we're going to pay in something that has now been devalued in the period which we promised to pay it and when we're actually going to pay it. So then if we scroll down, then we're going to have to record the fact that the payable is going to go down when we record it in US dollars by the 400, and then the foreign currency transaction gain is going to be on the other side. So now we've got the payable is now at the 32,600, which you'll recall is that 20,000 times the 1.63. So there's our 32,600 it's currently valued at. And then again, the other side going to, of course, the gain recorded on the income statement. What has not changed is the inventory. We didn't change the inventory. We're not revaluating the inventory due to the fact that the currency has changed that we promised to pay in. So we're going to pay this thing in the following year. So now note that we're on year 2 in terms of the trial balance. Now year 2, that just means what we did is I took the ending balances here are now the beginning balances for the second year. And then we have nothing in the entries at this point in time. So we have no list of entries because it's the new year now. However, all the stuff that was in the equity, so the 100 plus the 28,160, all these added together are now included in, and I'm just putting in retained earnings in the equity section. So now we have our post-closing trial balance, and we're moving on to the next year where we're just going to record the current information that happens in the following year, and we have nothing in the temporary accounts, the income statement accounts. Okay, so now what's going to happen is we're going to pay off the payable, but before we do so, time has now passed. Once again, we're going to have to revalue the payable. So let's consider what it was at before, the 32.6 that we just looked at, and then we're going to do our calculation for the next time period. So the next time period is going to be 20,000 times, now we're at 1.64, and so that's going to be 32.8. It's at 32.6, so 32.6 is going to have to go up to 32.8, so minus 32.6, there's going to be a $200 difference. That's going to result in a loss. Why is it a loss? Because before it was 1 pound was $1.63. Now 1 pound is $1.64, and we're going to be paying in pounds. And the pound just got stronger because 1 pound is now worth more dollars than it was prior to this. And the fact that we're paying in pounds means that we're paying in something that is now worth more. We have to give up something that's worth more than it was just a little while ago when we had been committed to pay this thing. So now we're going to go down and say, all right, so now we're going to have to revalue the $200. So the foreign currency transaction loss is going to be $200, and then the payable is going to increase by 200 to the 32.8. And once again, that 32.8 is going to be the 20,000 pounds times the 1.64, which is the 32.8. So now we can pay this thing off at the current price, that it's reflected at the current value. But before we do, we're going to have to get us some pounds because we have dollars. We have to get pounds. So we're going to go ahead and say, okay, we're going to credit cash for the 32.8, and we're going to buy us some pounds. We're going to then get pounds, which means the foreign currency units. So obviously, once again, that's the same calculation at the 20,000 times the 1.64 current spot rate. We're giving up $32,800 cash in order to get foreign currency units, which are 20,000 pounds, which we're going to record on our books as basically an asset, just like any other asset, but we're going to measure it in US dollars. So those 20,000 pounds are now measured as $32,800 worth of some asset, which happens to be another currency, which are pounds. So if we record that, then we're going to say, okay, now we got the foreign currency pounds, 32,800, and we now have the other side being cash going down. So now we have the foreign currency at the 32,800, which represents the 20,000 pounds. We got the payable of the 32,800, which represents the current value of the 20,000 pounds, and we can go ahead and just pay this thing off. So the next thing is, of course, to decrease the payable. So now we're just going to pay off the payable. We're paying it with the 20,000 pounds, which are now worth $32,800, and then we're going to decrease the foreign currency, which represented the currency that we're holding on, which was 20,000 pounds, which represented $32,800 worth of pounds. We're going to remove those two, bringing the foreign currency units down to 0 and the payable in pounds down to 0. So at the end of all this, at the end of these 3 transactions, here's where cash is. We've got the foreign currency Canadian units still on the books. We've got the foreign currency for the pounds now at 0 because we paid off the liability for it. We've got the inventory on the books that we purchased, basically purchasing it. It's on the books at the original kind of exchange rate when we actually received the inventory. It's machinery, same way. When we actually received the machinery, we put it on the books at that exchange rate. And then we recorded gains or losses for the differences between the payments and the point in time that we got the machinery as gains or losses on the income statement, which rolled into retained earnings for the prior year and are currently in retained earnings in the current year. The accounts payable for the yen has been paid off, as well as the accounts payable for the pounds. Retained earnings, which I believe was originally 100,000, but the prior period transactions rolled into it, and then the current period gains and losses are recorded in the income statement as well.